So lots of experts and YouTubers and those in the media will always show you different various charts and graphs that seemingly means that the end of the world is about to happen very soon. In the stock market at least. Sorry, that was a bit dramatic, but you get the idea. So far we've had high inflation data, a stock market in free fall, worries about China's imminent collapse, the rise in interest. Alright, I think you get the picture. There's a ton of bad news out there, and for some reason everyone wants the I told you prize if we ever have a big stock market crash. I'm looking at you, Mr. Michael Burry. The problem I want to address is that if you use any of these as your yardstick to start investing, I think you'll probably never get started and you'll be terrified as well. I see it all the time in the comment section across YouTube saying, I'm staying in this much cash, or I'm waiting for the crash, there's more pain to come, and they speak with so much certainty. Figures get talked about, data gets crunched, and it always ends up negative, at least in the stuff we hear. So I wanted to address several different major charts and indicators that keep getting pulled up on YouTube and around the media, and break them down to show you that it's really not as simple as saying that the stock market is expensive, overvalued, and it's not a good time to invest. Let me show you why that might look obvious on the surface isn't quite the full story and could end up costing you a lot of money. First up, the famous Shiller PE, most notably what's formerly known as the cyclically adjusted PE ratio. Basically, it's adjusted for inflation so you can compare the time periods more accurately, and it uses a 10-year average too. It's pretty cool. The PE ratio, or price to earnings ratio, is one of the most popular valuation methods people like to use around the stock market. In its most basic sense, you just divide the price of the company, i.e. the total market cap, which is just all of the shares times by the price, then you divide that by the earnings, which are effectively your profits. So for example, Apple right now is $174.55, and there are over 16 billion shares, which gives us a total price or a market cap of $2.81 trillion. Now, if we grab their earnings, or in other words, their profit for the year, we get 94.68 billion. And then very simply, you take your 2.81 trillion and you divide it by 94.68 billion, and you end up with the ratio we need, which is 28.84. That's the current PE as of filming. The PE ratio tells us that Apple's entire company value is 28.84 times what it earned last year. Now, you can do lots of things with this information. You could say it's expensive, you could say it's cheap, you could compare it to other technology companies, you could also compare it to the overall stock market like the S&P 500 index or even the Nasdaq. Remember that it changes all the time though as the stock price changes. It's just a ratio that tells you as an investor what people are happy to pay for the earnings of a company at any given moment. Now with the CAPE, the cyclically adjusted PE ratio, here's the latest data up until today. Over the long term, you can see how it varies through all the different stock market crashes and crises. If you put an average line over this graph, you'll then see what we're about to talk about. The long-term average is 16.97, so call it 17. Now that appears to suggest, like some on YouTube have said, that anytime the market is above this line, then it looks overvalued and expensive. And it got really bad during the run-up to the dot-com bubble and was also pretty high before the great financial crash. However, right now, it's also looking pretty high, so at first glance, if someone showed you this on YouTube, you'd think, wow, the stock market is definitely overvalued. Save your money, we need to wait until things go back under the average line, right? It sounds straightforward, but it misses some really key lines of thinking. First up, let me show you what some of the academics have said because it's really, really interesting. In this paper from 2018, the author wanted to know if the CAPE ratio was something that would be useful for making long-term predictions about pricing in the stock market. In short, they wanted to know if this would help us investors be better market timers. In summary, here's what was concluded from the research. There has in the past been times when if you had a high ratio, your future returns, at least over the next 5 to 10 years, were likely to be not as good as when you were starting from a much lower point. You can see that here on this graph that shows the following annualized performance for the next 5 years based on the CAPE ratio at any given time. You'll see that at least in the extreme cases, say above 35, almost every dot sits below the zero line, which means negative returns over the next few years. Nothing huge, just a slight drop each year. However, go back along the line to a CAPE ratio that we're sat at now to around 30, and it's not so clear. Some years have been bad, but most of them have been positive returns, but just not as good as before. And that's really just the market returning back to an average, especially because we've had a really great few years of really exceptional returns. More importantly though, the paper asked the question, can you time the market with this knowledge in the short term? What about the stock market in the next year after a high CAPE ratio, for example? That's what we all want to know, right? Let me read you one of the conclusive points from page 6. No matter whether CAPE is low or high, the return of the next subsequent year, unlike the longer term returns, was less dependent on CAPE. The R-squared of the regression analysis is near zero, also indicating no relationship between CAPE and the subsequent 1 year returns. So basically, good luck trying to time the market just because you look at a CAPE ratio. Anything can happen and there's no correlation in the short term that would suggest that it's going to help you. Secondly, are you really going to compare the stock market of 1900, 1920, 1940 and 1980 of the market today? Are you really going to compare the kinds of companies that were the big part of the markets from many decades ago when the world has changed massively? New technology companies today can scale and sell their products globally at a speed that was never possible. So is it a surprise that investors would be happy to pay a higher PE to them than if you compared it to an old oil company or even a railroad company? Data's great and all, but sometimes the information we're looking for can get lost if we pick and choose the wrong parts. What is always guaranteed returns though, if you can press the like button for me and subscribe too, why not? It really helps out small channels like mine loads. But with that done now, let's get back to the stats. Oh, and don't forget that the PE of any business is just the price that the market has set on that time and place. It changes all the time and is driven by sentiment and expectations, fear and greed. None of us know what the future will hold, so it's just a matter of guessing. How much we're willing to pay for the profits of business in the future is really up to the market to decide, and of course, we're part of that market. A PE ratio or a CAPE ratio isn't expensive or cheap at 20 or 30, it's only telling you what something is now compared to the past. Deciding whether or not you'll make your investing based on that is a whole nother ballgame. Okay, next data point that gets brought up a lot is this one, GDP in relation to the stock market values. So this one again takes the total market cap or value of all of the companies in the stock market and then compares that to GDP, which is what you get when you add up all of the value of the goods and services sold in any given country. Now in theory, you'd think that growing GDP and a strong economy must then mean a strong stock market and vice versa. Slow growth or even a recession like we've seen in the US from the latest GDP declines would surely mean that the stock market would fall. Well, again, it's really not that simple and straightforward. So here's the chart we're looking at. Funny thing, it's actually known as the Buffett indicator because he does actually view this as a very good measure of where we are right now in the stock market. As you can see, from around 2011 and 2012, pretty much after the recovery from the great financial crash, the stock market has been an almost non-stop tear into territory that makes it look really expensive if we look at it on face value. So the question is, can we use this as a useful indicator for future performance? Again, like the last chart, this has been another hot potato that's been looked at by academics. This paper from the Bank of New York Mellon, I always like saying that name, looked at whether there was much relationship between GDP and the value of the stock market. As you can see from the front page, the summary pretty much gives us a clue to where I'm about to go with this one. Essentially, it's complicated. As they say, I quote, "As counterintuitive as it might seem, data suggests that high growth rates do not necessarily correlate with the highest long-term stock market returns. Nevertheless, major stock market movements," he says, "may contain valuable information for economic forecasters." I won't bore you too much and drown you in the data on this one, but the bottom line is not good if you were hoping to use some kind of chart to predict the future of the stock market and when you should invest. Here's what they say. Over longer time periods, the statistical correlation between the quarterly change of real US GDP and the S&P 500 is virtually zero. One thing that was interesting though, which leads us towards a conclusion for this video, is that the pricing of the stock market is heavily linked to consumer confidence. Not really surprising when you think about it hard enough that the way we feel massively affects how we choose to invest our money, or not in some cases. When we're feeling flush and all of our stocks are in the green, we feel invincible, we can't lose and we want to keep getting more of that good feeling. And then on the other hand, when stocks are going down, the news is full of gloomy predictions about the stock market from people like Michael Burry or the latest Chinese property market crash. No surprise, during those periods, people save their money, sell their stocks, sit on the sidelines to wait again until things go back up. You just can't avoid good old human emotions in this market. I actually like this quote they've put in here from legendary investor Peter Lynch. He said, "If you spend 13 minutes a year trying to predict the economy, you've wasted 10 minutes. Now, don't get me wrong here. I'm absolutely not trying to say that valuations don't matter and that you just YOLO everything you have into the stock market. I'm just trying to provide some balance to some of the bearish voices that you hear all around you, because after all, we're always attracted to those stories about a possible crash or recession. It's just part of our nature. And if you look into it from a psychological perspective, you'll discover that we're biased toward loss aversion. So headlines that worry us attract our brains a lot more than thinking about possible gains. Valuations are really important, especially when looking at buying company stock and any investment. 2021 last year should have taught us that looking at all of the companies rising to huge valuations with virtually nothing really to back them up. However, for those of you out there waiting for a crash or another correction all the time because these indicators are flashing, we'll be left disappointed with a lot of cash. Reminding me about another Peter Lynch quote that more money has been lost anticipating crashes than in the crashes themselves. To combat the unknown, remember we've got a few tools that we can use to really help us. Firstly, remember that we can invest as many times as we like over a really long period of time. We don't have one chance to get this right. If we consistently invest into low-cost index funds or companies that are priced well, not trying to time the bottoms, then over the long run we'll do really well as our average cost should end up lower than what we actually end up with. Also, what's the alternative at the moment? We've got high rates of inflation, poor savings rates from low interest rates, we've got almost non-existent rates from bond yields that are negative, and there's really nowhere else to hide. The stock market remains, in my opinion, the best place to build long-term wealth, but it's not going to be fast process and we're definitely not going to be able to time the bottom. This process takes many years and really, it's mostly pretty boring. If I leave you with anything, remember that you'll always find negative stories and voices giving you so many reasons not to invest or to wait out the market. But if you go back during every time period in history, you'll always find those headlines and you'll always find someone showing you some chart or line of a graph explaining how they're expecting a slowdown or even a crash. In truth, nobody knows what's going to happen. All we can do is control our own emotions and forget about timing the market. Even though it's very tempting and plenty of people will still try to do it, maybe forevermore. On that note, if you've enjoyed the video, don't forget to watch this next one where I look at some of the most important lessons about building long-term wealth from the master himself, Warren Buffett. Anyway, see you in the next video, and as always, happy investing.